I want you to imagine you've been staring at a chart for 45 minutes. You've got your indicators lined up, your entry looks clean. You take the trade, and within 60 seconds, the market just reverses on you. Hard. Sound familiar? Here's the thing. It wasn't bad luck. It wasn't your stop loss. It wasn't your entry. The problem was that you were making a trade on a 5-minute chart without ever once looking at what the daily chart was doing. You were basically arguing with the ocean over the direction of a wave. This is the single most costly mistake retail traders make. And today, I'm going to fix it with a framework called top-down analysis. I'm going to show you exactly how professional traders and institutional desks use this to find high-probability setups that most retail traders never even see coming. So here it is, the complete breakdown of top-down analysis, smart money concepts combined with price action, from someone who spent years watching the market eat people alive who ignored this. The first thing you need to understand is that price on a lower time frame is always a servant of price on a higher time frame. Always. Most retail traders do it backwards. They open a 15-minute chart, see what looks like a clean breakout, and they're in. They didn't check the weekly. They didn't check the daily. I've seen traders with genuinely good instincts get destroyed because they had a brilliant 5-minute read inside a 4-hour downtrend they just never bothered to look at. So here's the framework. You always start at the weekly chart. Then you drop to the daily, then the 4-hour, then the 1-hour for entry refinement, and finally, the 15-minute or 5-minute for your actual trigger. That's your hierarchy, top to bottom, every single time. On the weekly, you're not looking for entries. Don't even think about that yet. You're reading the macro story of the chart. Is price in a range? Is it in a clear uptrend? Is it grinding against a major resistance level it's already rejected 3 times? That weekly level, it doesn't care what your 15-minute chart is doing. It's going to assert itself, whether you respect it or not. Now, once you've got your weekly context, you need to identify what I call institutional levels. These aren't your basic support and resistance drawn with a crayon. These are price zones where large capital, we're talking hedge funds, banks, proprietary trading desks, have historically entered or exited. You can spot these by looking for 3 things. 1. Strong impulse moves. When price rockets away from a level, that's institutional interest. They had orders there. 2. Fair value gaps. This is a smart money concept you need to understand. When price moves so aggressively in one direction that it leaves an imbalance, a gap between one candle's high and another candle's low, that's an area the market will almost always come back to fill. Think of it like a magnet. Price got pulled too fast in one direction, and it will retrace to collect the liquidity it left behind. 3. Order blocks. These are the last opposing candle before a major move. If price rallied hard to the upside, the last bearish candle before that rally is your order block. That's where institutional sell orders got absorbed. When price returns to that zone, it often reacts again because the same institutional players are still active at those prices. Mark these levels on your daily and 4-hour charts. These are your anchor points for everything that comes next. Here's something most retail traders genuinely don't understand. The market is not moving randomly. It's moving to collect liquidity. Every time you put a stop loss above a recent high or below a recent low, and let's be honest, almost everyone does, you are placing your stop exactly where the smart money wants to go to before reversing. They call this a liquidity sweep or a stop hunt. You've probably seen it. Price spikes just above a clean high, triggers a wave of stop losses, then reverses aggressively in the opposite direction. That wasn't manipulation. That's the mechanics of how institutional orders get filled. They need your liquidity to enter their positions. So when you're building your top-down analysis, you need to identify where the buy-side and sell-side liquidity pools are sitting. Previous week highs and lows, equal highs, equal lows, swing points that have formed clean, obvious levels, because obvious levels attract obvious stop placements. Once you know where that liquidity is, you can actually anticipate the move instead of being the one who funds it. Now you've got your weekly bias. You've got your institutional levels. You know where the liquidity is sitting. This is where the 4-hour and 1-hour charts come into play. On the 4-hour, you're looking for market structure. Specifically, is price making higher highs and higher lows in line with your weekly bias? Or is it breaking down? A break of structure, where price closes beyond a previous significant low in an uptrend, is your signal that something is shifting. Don't force the old bias. Let the structure tell you. On the 1-hour, you're refining. You want to see price return to one of those institutional levels or fair value gaps you marked on the higher time frames. If price comes back to a daily order block, starts showing bullish structure on the 1-hour, forms a fair value gap on the 15-minute, that's Confluence. That's not a guess. That's a framework. 3 time frames confirming the same narrative is what separates a high probability trade from a coin flip. The entry is actually the last thing you think about in this process. Most retail traders make it the first. That's the problem. Once your higher time frames are aligned, your institutional levels are identified, and your 1-hour structure is shifting in your direction, then you drop to the 15 or 5-minute for your trigger. Look for a change of character, a shift in short-term structure that confirms the move you anticipated from the top down. Enter with a clearly defined stop, not at round numbers, not at just below the wick. Your stop goes below the institutional level or order block you're trading from. If they were wrong, the trade was wrong. And here's the one thing most people skip. Document it. Write down why you took the trade, which time frames confirmed the setup, where the liquidity was, what the institutional level was. Because if you can't explain the trade in one paragraph, you don't fully understand it. And if you don't fully understand it, you're guessing, no matter how good the setup looked. So let's bring this together. You start weekly. Read the macro story. You identify institutional levels, fair value gaps, and order blocks on the daily and 4-hour. You understand where liquidity is sitting and why it's a target. You confirm your bias on the 4-hour and refine on the 1-hour. And only then, after all of that, do you look for an entry on the lower time frame. That is top-down analysis. It's not a magic system, but it is a process. And a process beats intuition in this market every single time. The traders who stay in this game aren't necessarily the smartest people in the room. They're the ones who stopped trading on gut feel and started trading with context. If you want to go deeper on smart money concepts and how to build a full trading system around this framework, I'm going to leave that video right up there. But before you click away, make sure you subscribe. This channel is going to save you a lot of expensive lessons. All right, I'll see you over there.